You've probably seen the headlines blowing up social media on the proposed 50-year mortgage. Supporters are calling it the hero affordability needs, with lower payments, bigger homes, and easier approvals. This innovative solution is going to bring out more buyers and create easier access. I want to talk about that, and I want to slam on the brakes because this isn't innovation. It's deja vu. Much like the 7-1 ARMs and interest-only loans and the option ARMs of the past, every solution provides benefits for the right buyer. But it's a massive risk when it's presented as a blend-all, cure-all. And while I can acknowledge that the 50-year mortgage is, yes, another tool for access, let's be clear. It doesn't solve affordability. It stretches it. And the real cost isn't in the payment. It's in the wealth you lose over time. So before policymakers go and crown this one a win, let's just look at the math together. What does this really mean for you, your money, and the American dream? So over the weekend, President Trump posted a photo comparing himself to President Roosevelt. FDR on the left, who helped create the 30-year fixed mortgage after World War II. And Trump on the right, promising a 50-year version for the modern era. That comparison matters. During the Great Depression, mortgages were short-term. They were interest-only, and they ended with a balloon payment. So when the economy collapsed, millions either lost or risked losing their homes. The government had to step in. They created the Homeowners Loan Corporation to refinance at-risk and foreclosing mortgages, and later authorizing the FHA in 1948 to introduce the 30-year fixed self-amortizing mortgage. The first time Americans could truly own their home and not rent them from the bank. That single change built the American middle class, creating stability, security, and generational wealth through home ownership. Now, fast forward to today, affordability is at its lowest point in decades. Home prices are up and the barrier to entry feels higher than ever. So on the surface, yes, a 50-year mortgage looks like a fantastic solution, a lower payment and easier entry. But does it actually solve the problem or does it hide it? So let's look at the math. Comparing the principal and interest payment on a 30, 40, and a 50-year amortization on a $600,000 loan at today's market rate of 6.25%. That 30-year fixed mortgage, principal and interest, is going to cost you $3,694 a month. The 40-year mortgage, it's going to save $300 a month and come in at $3,406. The 50-year mortgage drops a little more to $3,270 a month. That's a $424 a month difference between the 30-year and the 50-year. And yes, that sounds like a win, but long term, you're paying for it. The total interest accrued on that 30-year mortgage is about $730,000. That's already a lot. On the 50-year, that turns into $1,362,000 in interest paid. Most people don't carry a mortgage for 30 years. I know that. So after 10 years, the 30-year borrower builds around $95,000 in principal reduction equity, while the 50-year borrower builds only $24,000. And that's not even comparing apples to apples, because the longer the term, the higher the risk, which means higher interest rates and higher mortgage insurance. So that 6.25% that you see advertised, it's actually going to price closer to 6.5% or 6.75%, which only further eats away at your so-called affordability. There's another risk to this proposed solution, and we've seen it time and time again with policy changes like the first-time homebuyer tax credit or the release of the option ARMs. We've seen other attempts at approving affordability quickly only increase demand. So while more people qualify for the same homes, sellers are going to raise prices, and this current cycle that we're in is going to continue. Instead of letting the market breathe right now and let wages catch up to flatten home prices, this could likely elevate home prices and prevent a healthy correction. The exact thing that we need to stabilizing housing for the long run. This isn't a housing solution. It's a short-term optical win that props up home values and makes true affordability even harder for the next generation. Now, let's be fair. There's another side to this, because there always is. I mean, many homeowners will typically turn a 30-year fixed mortgage into a 50-year anyway, just by refinancing it multiple times. So in theory, this just formalizes what's already happening. But my question is it? I mean, a homeowner can refinance and they can consolidate debt and they can pull cash out because they've built up equity in order to do so, of which principal buydown is part of the equation. Another win could be called for first-time home buyers whose income is either projected to grow, or this opens up the door for their first step, and a 50-year mortgage could arguably be compared to renting. I could also look at it for somebody who's planning on owning that home for decades. So a 50-year mortgage might just offer that step into ownership that otherwise feels impossible, especially if they plan on accelerating their mortgage payments down the road, or even better yet, investing that difference at monthly savings into a higher return opportunity. When it's used with guidance and a good advisor who can help you make those right decisions, it could be the win. But only if a buyer sees the true aspect of what that lower payment could likely cost them. And here's where I get cautious, because math and strategy matter. Of course, I know that it's not just the principal buydown that builds equity. It's also the tax benefits, the forced appreciation from upgrades and remodeling, and the market appreciation that comes over time. I talk about this all the time as the pillars of wealth development. I mean, home ownership, even on a 50-year, is still the greatest path to stability and long-term wealth. But when you add those extra 20 years to the loan, you also add more interest paid monthly, as well as over the life of the loan. Higher interest rates, since longer terms carry more risk, and higher mortgage insurance premiums, especially for first-time home buyers, since risk-based pricing kicks in. So if I'm being honest, most loan officers won't walk buyers through this math. They'll focus on the smaller payment, not the slower payoff. I'd like to see ultimately more relevant conversations when it comes to solving affordability, not just creating a 50-year mortgage. Affordability isn't just about the monthly payments. It's about policy and infrastructure and opportunity. We need real solutions, like cutting red tape so builders can actually build, managing the federal debt that impacts the 10-year treasury and mortgage rates, and reining in unregulated HOAs, rising property taxes, and insurance costs that hit every homeowner. So I'm not saying the 50-year mortgage couldn't be one more tool, but we can't keep applying financial band-aids and calling it progress. So yes, this might help a few buyers qualify today, but at what cost tomorrow? When we stretch debt instead of solving the problem, we don't create affordability, we delay it. I'm Nicole Ruth, and I believe the path to wealth isn't longer loans, it's smarter strategy. So I want to talk and build solutions that last. I'd love to hear what you think. Would a 50-year mortgage help you with purchasing a home, or would it be stretching the problem? I'll look forward to seeing you next week.